Welcome to this third lecture in the Introduction to Banking. As I've just said, I still need to talk a little bit about the peculiarities of the German banking sector. As you know, we have three pillars in the German banking sector. One is for private commercial banks. The second pillar is the one for the state-owned and the municipality-owned banks, and especially savings and loan associations. And the third pillar consists of cooperative banks or credit unions. Now, for the state-owned banks, the Sparkassen in Germany, the defining element of these banks is that they are usually owned by the counties and or by the cities, so at the lowest level of government by the municipalities. And usually these banks have been formed and they've been founded so that municipalities, counties and cities were able to grant loans to their own citizens and also to support local activities like, for example, sports clubs, cultural clubs, etc., and some events. They usually, but not always, have a special legal form, which we call, in German, it's Anstalt des öffentlichen Rechts, which translates into, sort of an institution of public law. So not private law, but public law. And they usually restrict themselves to offering certain banking products, banking services, and only at a local level. So, for example, the Sparkasse Leipzig will only accept customers who live in Leipzig. If you live in Hamburg, if you live in Munich, Sparkasse Leipzig will not accept you as a customer unless you either work here or you have a flat or a house here in Leipzig or the vicinity. They are not legally forced to do that, but all the Sparkassen have agreed on, have a common understanding that they will not accept customers outside of the local municipality. So these are usually the Sparkassen, the savings and loan associations. You could also say that Deutsche Bundesbank is also such a state-owned bank. Of course, it's the central bank, so you have this is a special case. The overall savings and loan association sector has also large institutions and head institutions which were founded decades ago to enable those small banks to offer financial services and also to facilitate the transfers from banking account to banking account. Those are, for example, the DK Bank. Also, each state, each Land, used to have its own Landesbank, which is very, very specific and very peculiar to Germany. Some of these Landesbanken have vanished, especially during the financial crisis, because they used to offer loans to local businesses and to support the political activities of the state governments. But at some point, they somehow, in some cases, for example, the WestLB, Westdeutsche Landesbank in North Rhine-Westphalia, they somehow lost their major business model and then started to engage in, activities like subprime mortgage lending and securitization. And several of these Landesbanken got into severe problems during the financial crisis and had to be bailed out and now have ceased to exist. There used to be 417 savings and loan associations and some free savings and loan associations, for example, the Hamburger Sparkasse, and the abbreviation is HASPA, Hamburger Sparkasse. It's what we call a free savings and loan association. It's a small legal distinction. And there are some other banks that are also state-owned, government-owned, but have a special purpose. For example, the KfW, I've talked about the KfW already. It's the Kreditanstalt für Wiederaufbau, the bank for reconstruction, which was instituted and which was installed after the Second World War to finance the reconstruction of Germany, but has now taken up, for example, the financing of remodeling homes in a very energy-saving way, and also financing solar panels on your roof and these sort of things. There used to be a very something special about the savings and loan associations. In German, we called it Anstaltslast and Gewährträgerhaftung, which means that the government was liable for the debt of the savings and loan associations. This is what these two things mean. And this was very problematic because when Germany entered the European Union, and the European Union and the European Commission started to look at the European banking sector, it realized that actually German savings and loan associations had a competitive advantage because they were owned by the German counties and at the end by the German state. And these savings and loan associations were given a direct and indirect bailout guarantee by the state because they are still state-owned. And the European Commission said this is an undue competitive advantage that cannot be the case in a single European banking sector. And if other European or banks from other European countries are allowed to enter the German banking sector and are expected to do business in Germany, and the other way around, this more or less illegal competitive advantage should be taken from German savings and loan associations. So this has been abolished a couple of years ago because, for example, the savings and loan associations, I think in Spain, do not have such a bailout guarantee. And of course, this was very hot topic issue almost a decade ago because the savings and loan associations in Germany back then believed that this would force them into a bankruptcy, but it didn't happen. As you can see, this was abolished in 2005. And the distinction between the two, the Anstaltslast and the Gewährträgerhaftung, simply is that the one means that if the bank is already bankrupt, the state has to step in, and the other one is even stronger. It means that the creditors can go directly to the state and try to get their loans repaid, even if the bank is not yet bankrupt, is not yet insolvent. So, in fact, it's literally the same. It's a bailout guarantee by the state. Okay. Yeah, and as I've said, both have been abolished by the European Commission. I've one example here for the balance sheet of the Hamburger Sparkasse, one of the biggest savings and loan associations, because it's the savings and loan associations are one of the largest cities in Germany, the HASPA. And as you can see, this is the asset side of the balance sheet. You can see that usually savings and loan associations in Germany are almost exclusively active in lending and deposit taking. You can see these are the loans granted to customers, to retail customers, and this makes up almost the entire asset side of the balance sheet of the Hamburger Sparkasse. This is very typical for most savings and loan associations, and in fact, if you look at the liability side, you can see this is just well, in German we call it Verbindlichkeiten gegenüber Kunden, which just means liabilities to customers, and these are of course the deposits, because what else does a bank have as a liability to its own customers? This is very typical of German savings and loan associations. The smaller ones are even more extreme in the sense that they almost only have deposit taking on their liability side and grant even more loans. There is also one reason why these smaller savings and loan association banks do not have any other business. It's because all the savings and loan associations are organized in a large group, which is the DSGV. which is the German Savings and Loan Association. It's the Deutsche Sparkassen- und Giroverband. And all the savings and loan associations are organized in this association. And this association is more or less the lobby group and the political activity group for all the savings and loan associations. And under the roof of the association, they also have a large asset management company and a large investment bank, and also an insurance corporation. So all the insurance products, all the investment banking services are offered by one large bank for all the small savings and loan associations. So the smaller ones do not have to have their own investment banking. They simply take up the services offered by the large institutions at the head of this savings and loan association. It's the same for the cooperative sector, which is the third pillar, the credit unions or the cooperative banks. The defining idea behind cooperative banks is that all the shareholders have the same share in the company, and shareholders are customers. It's the same as with mutual insurers, or sometimes we'll speak of mutual banks. They are more or less companies with shares, but customers have to become a shareholder, and each shareholder has the same share in the company, so you cannot be a majority shareholder. In German, the legal entity for this is eingetragene Genossenschaft, which means a corporation. And you can always see that, for example, if a Volksbank, let's take my hometown, Kam Werne AG. So this is the cooperative bank of the city, and it's organized as a credit union and as a cooperative corporation. Also, just like the savings and loan associations, most of the cooperative banks only do business in their community, in their local county, and they will not accept customers from outside. There needs to be a reason why the bank should accept you. If you become a customer, you immediately become a shareholder, and you have to pay like 20 or 30 euros for a share in the credit union. And they usually, just like the savings and loan associations, concentrate on lending and deposit taking. Again, just like the savings and loan associations, they are also organized in a large association that functions as a lobby group for all credit unions. And they also have large institutions at the head that offer investment banking, insurance products, etc. Okay. Actually, this is old. They have also merged. We only now have one large bank at the center of this association, which is the DZ Bank in Frankfurt. It's a large bank in Frankfurt. And if you have read the news today, there was a newspaper article that came out today that the DZ Bank, as one of the first banks in Germany, has announced that they will no longer finance coal power plants. And this is actually, I think, the third largest bank in Germany right now. We have about 1,000 credit unions and mutual banks. In German, we usually call them Volksbank or Volks- und Raiffeisenbanken. There are 10 Sparda, Spar- und Darlehenskassen, which is, again, saving and lending bank. Some PSD Banken, they are only for private customers. And Union Investment and R&V, Insurance, R&V-Versicherung, those are the large insurance and asset management corporations of the whole group and of the whole pillar. And there are also some special banks. For example, how do you call them? The Bistümer. The local sections of the Catholic and of the Lutheran Church in Germany, they also have banks. And these banks are organized as cooperative banks. For For example, the large bank of the Catholic Church is the Pax Bank, Pax as in peace. And another special case is the Japo Bank. The Japo Bank is the pharmacies and physicians bank. So if you, in Germany, you want to start your career as a physician, as a surgeon, or if you want to open your pharmacy, usually you need a lot of financing for all the equipment, especially, for example, if you open like a radiology surgeon, physician's office. You need to have large X-ray machines. They usually cost 1, 2, 3 million euros, and you need a lot of financing, and you usually have no assets if you come directly out of your studies and right out of university. So the APO Bank has specialized on granting loans to young physicians, surgeons, and pharmacists, so that they can open up shop. And that's why they're called APO Bank, because it's Apotheker and Ärztebank, Apotheker und Ärztebank. It's actually one of the largest banks in Germany, and only few people know that it's legally it's a cooperative bank. Okay, so these are the 10 largest banking corporations back 5 years ago. You have Deutsche Bank, Commerzbank, KfW, DZ. UniCredit is in Germany is HVB, Hypovereinsbank. Then you have LBBW, Landesbank Baden-Württemberg, owned by the state of Baden-Württemberg. Norddeutsche Landesbank, Landesbank Hessen-Thüringen, und Postbank AG, which is owned by Deutsche Bank again. Okay. On the next few slides, you can see the distribution of assets, the number of institutions, the number of local offices of the different banking sectors, and one could say that all three pillars are almost of equal size, more or less. Of course, the Landesbanken are much smaller than the rest, but you can also count them as a state-owned bank. Okay. So this should give you a general idea of what the German banking sector looks like. We have Sparkassen, we have cooperative banks, and we have private commercial banks, and we don't have too many private commercial banks. In contrast to many other countries, like for example the US, we have extremely large private banks. Deutsche Bank, Commerzbank, UniCredit, HVB, Postbank, again owned by Deutsche Bank, and a few others, but this is it. In the US, we have thousands, literally hundreds and thousands of small, medium, and large banking corporations which are privately owned, and this is different in Germany. Okay. So, do you have any questions concerning the three pillars of the German banking sector? If not, let me just switch to the part on financial intermediation. We stopped there last time. And as you might remember, we've talked about reasons why banks exist, what banks can offer in contrast to the financial market, simply substituting for banks to facilitate the transfer of funds from usually investors to corporations, to firms who want to finance investment projects. Now let's talk about delegated monitoring. We have seen that we need to control the actions of the firm, and we need to monitor the actions of the firm, because we are asked, as an investor, we are asked to finance the investment project of a firm. We can give our money to the firm, but we have no idea what the firm actually does, and in some cases it might defraud us, it might tell us the project didn't go well, we are not able to repay our loan, and we have no way of knowing what the project will actually generate in revenue. So one reason for banks to exist could be that instead of us as investors monitoring each and every possible project and each and every possible firm who wants funding from us, it might be easier to go to a bank and to ask the bank to do the monitoring for us. And because the bank specializes in monitoring and we delegate this monitoring to the bank is able to save on monitoring costs, and it can offer a service that is worth some money to us. So banks as delegated monitors. It could mean that monitoring costs are lower if a bank does the monitoring instead of each and every investor. So we have a financial intermediary, and the financial intermediary takes over the monitoring for us. And we have monitoring costs of 1 times C. The bank only has to do the monitoring once, whereas if M investors are interested in investing into this firm, each and every investor would do the same monitoring and generate the same costs over and over again. So we would have M times C costs. The problem is we need to make sure that the financial intermediary is honest. It could be that as an investor, we would go to the financial intermediary and the bank would just tell us, yes, we have done all the monitoring, we have evaluated all the possible projects, and they could just give us false information. So this is one problem. The bank could still defraud us. So we have delegation costs. These are the necessary costs to solve the monitoring problem and the cooperation problem that exists not between the investor K and the firm, but now between the financial intermediary and the investor. We need to make sure that we can trust the bank. So this is what is necessary. And to explain the existence of the financial intermediary, we need to show that even though we have to incur new costs for monitoring the financial intermediary, that even though we have to monitor the bank, this additional cost is still lower than the overall cost. So it wouldn't make too much sense if the money saved by delegating the monitoring of the firms to the bank, if this if this saving on cost is eaten up by the cost of monitoring the bank. So it should be cheaper for us to monitor the bank instead of monitoring all the firms. So the model, we still assume that the financial intermediary is risk neutral and does not have own capital, so it cannot simply invest on its own. So it can do the monitoring for us, but it cannot simply substitute the investor. The financial intermediary gets cash flows from the investors. It finances projects coming from the firms. It gets the revenue out of the projects from the firms, and it gives a part of the revenues out of the projects, again, back to the investors to repay the loans. So this is shown here. We have the firms on the left-hand side. We have different investors 1 through M, and we have the financial intermediary who can now step in, and we need to show that this is cheaper. The total cost of the financial intermediary, those are the costs of doing the contracts with the firms, of giving the loans to the firms, and of course the costs of delegation and of delegating the monitoring by the investors. Now, the costs are relatively low, but the financial intermediary, of course, it creates information asymmetry. The investor does not know what the bank actually does and whether it can trust the information provided by the banks. Now, we substitute the direct investment of the investor into the project of the firm by investing in the financial intermediary. Think of this like this. If you go to a bank as a customer and you give your money to the bank and put it on your savings account, you are more or less investing in the bank, and you expect that the bank is able to pay you interest on your savings account. And this should be somehow better for you than simply going out there and looking for firms who are in need of a loan. So for some reason, this is cheaper for you and you save on costs. You would expect that you have the same probability of default and you have a smaller revenue because you have monitoring costs, additional monitoring costs. Now, how can you save and how can you lower the costs of delegating the monitoring to the financial intermediary? The financial intermediary can finance several projects of several firms. So it can diversify and it can lower the risk. Again, this is very realistic. If you have the opportunity to invest in, say, a loan to a firm, of course you have one risk profile, the risk profile of that particular company. But if you go to a bank and you put the money on your savings account, you would expect that this money is distributed among a subset and a portfolio of different investment projects, and the risk is diversified. And this happens, of course, here with the financial intermediary. So the bank receives N times M K receives investments and payments from N times K investors, and it can invest in N projects. Each investor has again an investment function, a contract, a financial contract with the bank that includes a penalty function. So the bank is penalized, usually non-monetarily, in a non-monetary way, in case the bank defaults. And the basis for all the repayments is, of course, the success of the projects. Yes?
And what are contract costs to you?
Contract costs. The costs of coming up with a contract. In reality, this would, for example, mean legal fees, fees to lawyers, time you need to invest to make the contract. But in fact, here, in theory, this is the costs and the opportunity cost you have because you need a contract, also with a penalty function, to force the other side to stick to a certain way of behavior. These are the contract costs. If you had a world, if you had a model with perfect information, you wouldn't have contract costs. Because in a world with perfect information, every model subject and every model agent would stick to a certain kind of behavior, and they would not violate a contract, and they would not violate, for example, a loan. You would simply see that the other party is defrauding you and is not sticking to the contract. But here, if you have a model with imperfect information and asymmetric information, you only can get to the second best solution. Is that clear? Okay.
So are you saying that the FI creates information asymmetries or symmetries? Because on the slide it's written that it creates symmetries, but you said that it creates asymmetries.
Well, it needs to... first, of course, there is an asymmetry because of the financial intermediary, because the financial intermediary solves the information asymmetry and the problem, the cooperation problem between the investor and the firm by making, how should I put it? If you enter the financial intermediary, you have no cooperation problem between the financial intermediary and the firm, but you get information asymmetry between the investors and the financial intermediary. And it needs to solve this, and it needs to create information symmetry by, again, offering an incentive-compatible contract. Okay. Now, because of diversification, the probability of a bad outcome of the project is relatively small, because the revenues are more independent than if you only invest in a single project, and you can lower Actually, this is not correct. By increasing the average and the mean revenue to the investors, you can decrease the welfare loss. So diversification helps to increase the average revenue back to the financial intermediary, and then of course back to investors. And this is what helps lower the welfare loss if you include a financial intermediary. Yeah? So you have diversification on one hand. Here you can diversify across all the different firms, and you can diversify, of course, here across all the investors to the bank. Okay, let's do a numerical example. Yes?
Yeah, one question to slide 98.
98.
The second point says if you invest in project XY, you have the same default risk, but lower revenue. Isn't that a disadvantage, having lower revenue?
Yes. Yes, you have lower, well, at first, yes, you have, if you have no diversification, of course you would have the same if you only, in a case where you have one investment, and you would simply say, okay, instead of directly investing into this project, I invest in the financial intermediary. Of course, you would have lower revenues because you simply have one additional step of monitoring. So you have higher monitoring costs compared to the situation in which you would directly monitor this one project. The advantage now comes into play when the bank is able to diversify. In that case, you have a lower risk of default, and again, you have higher monitoring costs because you have to monitor the financial intermediary, and the financial intermediary has to monitor all the investment projects. But this additional monitoring cost could be leveled out by the higher average revenue due to diversification. But this only works, of course, if the bank, if the financial intermediary is able to invest into several projects. So this is, you have to put an emphasis on the singular here. If you only have one project, then of course entering a financial intermediary in the model would not make much sense. But in case you have several projects, you have the advantage of diversification. Okay. Now let's do the numerical example. We have a financial intermediary who uses the cash flows of n times m, in this case 30 investors, to finance 3 projects. Now all 3 projects have the same known revenue stream. We have Y1 equals 1.5 units of money. P1 is 0.6, so the probability of repayment, and Y2 is 0.8, with a probability the project defaults of 40%, and in this case we would only get back 80% of the 1 unit of currency we initially paid to the firm. So again, we would have such a distribution 1.5, and we have 60% probability, and here we lose some money and we have 40% probability. Now the financial intermediary monitors all the firms. It receives monitoring costs from each company in the size of 0.03. Why does it receive? Well, the company needs money, and the bank is only willing to grant a loan if they are being paid a certain amount of fee for their costs of monitoring the project. So the bank receives the monitoring costs. There is a repayment agreement with the firms. They will pay back 1.4507 units of currency. We had that on one of the earlier slides, in case the project is a success. And a repayment of 1 unit, so it will repay the whole loan of 1 unit of currency minus the monitoring fee, in case the project is not a success. And if all the 3 projects are independent, if the portfolio is diversified, this would mean that we have the following total revenues to the financial intermediary. So we now have to go through all the possibilities. 3 projects, 3 successes. 2 successes and 1 failure, 2 failures and 1 success, and the last one is a case in which all 3 projects will default, all companies will default. So 4 scenarios. This again, the first one is the case in which all 3 companies will not default, and the last one is the case in which all 3 companies default. And if the portfolio is diversified, all 3 random variables are independent of each other, and if they are stochastically independent, you can simply calculate the probabilities by multiplying probability with probability and probability. Okay. Each investor receives 1/30 of the revenues. Because of diversification, an investment in such a project is favorable than a direct contract with one of the companies, and the investor only has to fear a default in 35.2%. In 28.8%, the losses are more moderate. So it's better for the company to invest in the financial intermediary, who then diversifies across all 3 projects, than simply investing directly into one project, in which case you could lose everything and have a large gain. Now, K is willing to enter this contract, even with the revenue of 0.11784 units of currency, in which case it would give the financial intermediary 0.1 units of currency. And on average, the investor will earn exactly the market return of 10%, so that it's a zero-sum game for the investor, and the investor is, it's irrelevant for him whether he or she invests in the financial intermediary or directly. And if we compare this to the direct contract between the investor and the firm, we have an advantage of 0.13, and this shows that we have a positive diversification effect, and it simply means that the investor will choose to invest in the financial intermediary rather than choosing a single project in which he would put all his money. Okay. Again, we have to compare the different scenarios and the different contracts. We have to compare here the 2 scenarios in which we have the direct financing of a firm and the financing of the financial intermediary. Now, without the financial intermediary, we would have costs per firm of the minimum of M times C and the average of the repayment function with the penalty function phi star. So we have 2 possibilities. Either we have to force the contract partners, we have to force the investors will force the company to disclose all information. This would be the second possibility. So this is it. we have to create a contract that forces the firms to disclose all necessary information. This will incur high costs. Or we would simply say, okay, we have to monitor the companies by ourselves. And in total, this would mean that each and every investor has to monitor his or her project he invests in. And this would mean we have M times C monitoring costs. You see the distinction? In the first scenario, we have monitoring. We have to pay someone, or we have to do the monitoring by ourselves. In the second scenario, we do not need monitoring, but we would only enter into a contract in which the other side is forced to stick to the agreements in the contract, because otherwise the firm would be punished, for example, in a non-monetary way. With a financial intermediary, we have a contract with monitoring between the financial intermediary and the firms, and a contract with the penalty function between the financial intermediary and the investors. So the costs for the companies are C plus D. We have the monitoring costs and the delegation costs. And the costs of delegating consists of the risk premium of the contract between the financial intermediary and the investors. And this is what we would compare here. Now, financial intermediation, which is this scenario here, of course, is favorable and should be done in case this is lower than the solution in which we have no financial intermediary. Now, with increasing N, the costs of delegation decrease because the financial intermediary is able to offer almost risk-free contracts. Think again of the Savings and Loan Association of a simple bank. If you go to a bank and you pay 1,000 euros on your savings account, you would expect that this is almost risk-free. Why? Because it's such a small amount in an extremely large portfolio the bank holds, and the bank is able to achieve almost perfect diversification in this large portfolio. So with N increasing and the bank's portfolio growing, diversification should become better, and the contract the financial intermediary, the bank offers, the deposit contract, this should become almost risk-free. And this would mean that the cost of delegation also decrease. Now then, the advantage of a well-diversified financial intermediary is given when C is lower than M times C and this contract with penalty function, and this is equivalent to C, again, the costs of monitoring being lower than here the loan contract with a penalty function. So what does it mean? It would only make sense for you to enter a direct financial contract with a firm in case C is extremely high, so the costs of monitoring, if these costs are extremely high, or in case the default risk is almost close to zero. And this would also make sense intuitively if I would give you the possibility to invest in a firm, and I would tell you the investment is almost risk-free. There is no chance the project defaults. And I would tell you that this project offers an interest that is higher than the market return or the risk-free rate. You would never consider going to a bank. You would immediately take up this investment opportunity and you would invest in this project. If you do have a default risk, you would perhaps go to a bank, invest in the bank, and let the bank diversify its portfolio because it is much larger. And it is able to lower the monitoring costs simply due to its size. Okay. Any questions? So you simply have to remember that in theory, in financial intermediation, it's usually about monitoring costs, delegation costs. There are newer models that look at banks as delegated risk managers. And the advantage of the bank is that it can offer a diversified portfolio investors can invest in. And it can do monitoring, and investors will delegate the monitoring to the bank because it can do so much more professionally than a simple small investor. Okay. We've already talked a lot about the more general functions of banks. You just need to remember that financial markets and banks in particular help to allocate capital, they help to select contract partners, they help to coordinate cash flows between agents in the financial market, and they engage in risk transformation, lot size transformation, and maturity transformation. Usually it's risk-free and safe deposits, short-term on the liability side, and long-term riskier mortgage loans, for example, and business loans on the asset side of the bank's balance sheet. Okay. Banks also have a macroeconomic function. We've talked about this a little bit. Banks facilitate the transfer of cash flows. They offer possibilities to invest. We've just talked about the fact that banks offer investors, and especially retail investors, the possibility to invest in a large, diversified portfolio, but they also create money. They are also active in creating money by multiplying and enlarging the amount of money that circulates in an economy. And this is perhaps one of the most important functions of a bank, and we'll have a small numerical example later on. There are also very basic functions, transformation functions. You can reorganize these functions as you like, but this is not very interesting. I think we've talked a lot about this as well. Banks engage in lending, deposit taking, etc., and also in investment banking and so on. We've also had the definition of banks and investment and commercial bankings. We have financial services that are offered. You can go through all this just to get, again, a feeling of what a bank can do. Most of these financial services are more and more offered by fintech companies, by small startup companies that try to engage in battle with the large banking corporations by offering better services, especially IT-based services. If you look, for example, here, the first thing, Anlagevermittlung, which is financial consulting and financial planning. This is a part in which fintechs are quite active at this time. And, well, I think most of these things are also self-explanatory. Leasing, Sortengeschäft is simply trading in currencies. If you go to a cooperative bank, if you go to your bank and buy $100, you need the bank to offer you this financial service, and so on. We've also talked about deposits a lot, and usually if we as customers deposit our capital with a bank, the total amount of capital that circulates in the economy is increased. And I will show you how this is done. This is also part of, I believe, the macroeconomic and financial intermediary and financial intermediation courses at our university. It works like this. Banks create money, they create book money, and this can be shown in a very simple model of the credit multiplier. It's based on the assumption and the fact that modern banks only need to retain a certain amount and a certain percentage of the money that has been deposited with them. So if as a bank, you as customers give me 1 million euros, I do not need to put this 1 million euro on my, well, I need to put it on my balance sheet, but I do not need to keep it in my safe. I'm allowed to do something with it. I'm allowed to offer loans to, for example, other customers and corporations, and I only need to retain a certain fraction of this 1 million euro in my safe. And by this very simple model, the amount of money that circulates in the economy is increased. So what happens? We need to retain a certain amount of the deposits, and this is well, what's called Rücklage in German. And of course, this provision we need to retain. This is needed to make sure that if customers come to me and ask for the repayment of their deposits, I, as a bank, am able to repay the deposits, because otherwise I would be bankrupt. I would default. The remaining fraction of the deposits can be paid out as loans, and banks will of course do this. For example, they will only retain 10% of the total deposits, and they will pay out loans in the amount of, say, 90%. So this is the first assumption of this model. There is only one bank in the financial sector. It retains 10% and it repays out 90%. So, small example. This is the asset side. This is the liability side, where 50, let's say euros, 50 euros. Actually, those are 50 million euros. 50 million euros deposits. And we have 45 million euros we give out in loans, and we retain as a reserve 5 million euros. And the mandatory reserve ratio is 10%. After one period, we increase the deposits by 50,000 euros, and we now need to keep 5,000 euros in reserve. And again, we have 45 million euros in loans. Now we can see that if the deposits flow into the bank and are not paid out as loans, our reserve ratio is increased by 0.1%. We only need to have a ratio of 10%, so we can reduce this ratio to 10% again. And what do? We pay out loans. And now we can pay out 45,000 euros as loans, and we again have 10% reserves. So this is what I've just described. Period 1, 10% reserve, 5 million euros in reserves, 45 million in loans, 50 million in deposits. We increase the deposits by 50,000 euros, and then we have a higher reserve ratio. We reduce it to 10% again, and we can pay out more loans. In period 2, we decrease the reserve ratio to 10%, and in this example, the credit multiplier, defined as the ratio of the changes in deposits compared to the change in the reserve, is 50.05 minus 50 over 5.00. No, actually 10 too much, I think. And again, this credit multiplier is 10. So you can see the credit multiplier is always the inverse of the reserve ratio, the mandatory reserve ratio.
But it has to be 5.005.
Is it?
It's 1, right? Because then it's 0.5 divided by 0.5.
Oh yes, it has to be. No, this makes 500. Is it correct here? reserve. Yes, it's after. Yeah, it's after reducing the loan. After reducing to the initial mandatory reserve ratio. Okay. Now we still have a multiplier of 10. We extend this model by including more banks. Of course, if we only have one bank, there isn't much going on in this small model. We need to have more than one bank. Now we assume we have more than one bank, and if Bank A sees an increase in its deposits by 50,000 euros and has a reserve ratio of 10%, the remaining 45,000 euros can be given out to other banks as loans. So the money is given out perhaps to Bank B or to an individual, a retail customer, who brings it to Bank B. Now this bank again has 10% in reserves and now invests it, for example, in an original loan. And this again could mean that the money is transferred to Bank C, and so on and so on. And each time we have €1 coming from Bank A given out to a customer who brings it to Bank C, the amount of money that circulates in the economy is increased by 90%, because each bank only has to retain 10%. Of course, has all the money on its balance sheet, but it can give out 90% again to other economic agents in the model. And in the end, you can see the sum of the additional deposits in the system with n banks is just 50 plus 50 times 90% plus 50 times 90% squared, and so on. And this geometric sum is 500 in this example. So it's 50 over 1 minus 90%, and we get 500. So according to this formula, in which the deposit multiplier is the inverse of the mandatory reserve ratio, it would mean that increasing and putting into the system 50,000 euros of deposits would increase the amount of deposits in the total system by 500,000 euros, just the deposits. And again, you do not need to have n banks, simply do it with 2 banks. It simply means that if you bring the money to a bank, you have a claim against the bank. The bank will take 90% of this euro, of each euro, give it out as a loan. And if this loan again finds its way to a second bank, you have an increase of the total amount of money that is on the books of the banks, an increase of 90%. So suddenly you have €1 of deposits at Bank A and 90 cents of deposits at Bank B, so 1.9 euros in total. And this is how, very simple model, but it shows you how banks can create money. And you suddenly have more money than the central bank has initially given out to customers and given out to banks and to the people of the country. This is very simple, a very simple model. And disadvantage is it's not very realistic because it would mean that all customers end up bringing all their money back as deposits to all the banks. And it could also be that bank is transferred overseas. So you cannot calculate the exact amount of money that is created, because customers could simply take the loan and do nothing with it, or transfer to a bank or a company overseas. And usually the retail customers will invest in government bonds, they will hold cash, instead of bringing all their money again and again to a bank and to invest it in deposits. But still, you can see that banks create money. The model is simply not accurate in the sense that it will not give you the exact quantitative figure by which percent the amount of money is increased. But you can see that the money created, the money that circulates in the economy is increased by banks. This is one reason why banks are regulated. Because of the economic importance of banks. Banks, in contrast to shoe companies, automotive companies and manufacturers, banks are heavily regulated by the state. And they are also under the supervision of government agencies, like the BaFin in Germany. And this is also one reason why deposit taking is so central for the explanation of financial regulation. If banks did not have deposits, regulation would look much different. And this is in many countries the case for, say, insurance companies, investment companies, and even investment banks. These companies do not take in deposits, and immediately regulation will look totally different. In case you have a universal banking system in which you have banks that operate both as an investment bank, as a commercial bank, of course regulation will be very tough. Okay. So this is one additional explanation what banks do and why banks exist. They have an economic function, and this is also why we usually distinguish between deposit-taking and non-deposit-taking institutions. So you have this here on the left-hand side, and you can actually see one additional distinction between deposit-taking banks and non-deposit-taking banks. Deposit-taking is risky in the sense that the deposit repayments and the outflows of capital out of deposit-taking banks, these outflows are random. If you all decide to go to your bank and withdraw your deposits today, the bank would be forced to do this. And this would be totally random. If I would tell you, for example, Sparkasse Leipzig is close to bankruptcy, you would immediately run off and try to withdraw your deposits. So the cash flows are more or less random in case deposits are involved. In case you have non-deposit taking institutions, the cash flows are much less random because you have institutional investors, you have large contract partners, and this is much more reliable than with customers who bring in deposits. Okay. So this is, the random withdrawal of deposits. Again, as a depositor, you can decide freely on the question when to withdraw what amount of money, and you can do so at any time you want. And this, of course, will cause some problems to the bank. Okay. Also, I might have mentioned this earlier. One could ask him or herself the question, why is a bank so heavily regulated and an insurance company not? Well, insurance companies are heavily regulated, but in a totally different fashion. Insurance premiums are much more reliable. For example, some of you might own a car. And if you own a car, you need a mandatory car insurance in Germany. And if you enter such a contract, you have to pay your insurance premiums every year. And every year, on the first day, in the first month in which you have signed your insurance contract, you will have to pay insurance premium. If you do not pay your premium, the contract is void, and the insurance company will not pay any damages and not any losses in case you have an accident. So this is much more reliable to the insurance company. If you, for example, go to a bank and deposit 5,000 euros, this is totally random. You simply might decide, okay, I have too much cash in my pocket, I go to a bank and I put it in my savings account. With insurance premia, it's much more reliable. And this is why insurance companies are regulated in a totally different way than banks, because the cash flows going into insurance companies are usually not the problem. Deposits are for banks, and for insurance companies, what are the major problems for insurance companies? It's not the premium. It's not the premiums, but the insurance losses. If suddenly you have a large hurricane, if you suddenly have a drought, if you have a natural disaster, your insurance losses will skyrocket, and this is what makes insurance business risky and much more difficult. Okay. So this is why insurance premia are not as problematic as deposit taking. I've talked a lot about financial intermediaries, and a financial intermediary can be a bank, an insurance company, a pension fund, an investment management corporation, an asset manager, and so on and so on. There is no exact definition what banking entails, what a financial intermediary is. In fact, if you look at different countries, even in the European Union, you will find different definitions of what a bank is and what a financial service company is, a financial intermediary. For example, you can take the UK's Financial Services and Market Act of 2000, and banks are allowed a variety of financial services. We've seen the exact definition and the paragraph 1 of the German Banking Act, the Kreditwesengesetz, in which you could see what is defined as a bank and what is defined as a banking service in Germany, but this will differ from country to country. For example, in the UK, banks are allowed to take in deposits, to issue electronic money, also to implement insurance contracts. Usually, I would say this has nothing to do with banking, but in the UK, a bank can do this. It can offer investments, it can manage investments, it can also act as a financial advisor, and this is all considered part of banking under the UK FSMA Act of 2000. Yes?
Is there something like a best working banking system or any horrible banking system that's still in place?
You mean best case and worst case scenario, or good and bad examples? I would say that bank assurance is quite tricky. I wouldn't know of any examples of whole banking sectors at the country level that work exceptionally fine or work exceptionally bad. But I would say bank assurance, so the idea to offer banking and insurance products under the same roof, bank assurance is actually quite tricky because you have different corporate cultures. You have usually this is done within extremely large corporations. Think of Allianz, Dresdner Bank, and this usually comes after a large merger. And I would say that these large mergers are problematic on their own, but bank assurance itself is also very problematic and quite tricky. I would also say that from an economic standpoint, a system where you have investment banking separated from commercial banking is better. You do not necessarily need investment banking within the same corporation as a commercial bank. And I think the experiences from the financial crisis should have shown that to regulators, but not in every country. Okay. Well, during the last decades, we have seen an extreme merger wave. An extreme process of consolidation within banking and the financial sector itself. And this is due to several developments. First, globalization. companies have started to buy up subsidiaries and to open up subsidiaries in other countries. Go back 20 years ago. 20 years ago, we only had German banks in Germany. Now we have different European companies, European banks working in Germany, opening offices. We have German banks operating in the US. And this is more or less due to the second bank directive of the European Union in '89 that allowed banks to work and to manage banking services as a universal bank within each and every country of the European Union. And the second reason is technology. Of course, due to the IT revolution, due to internet and communications technology, banking is much more based on IT nowadays than it used to be. This has increased, of course, costs at some points for the IT. It has decreased the cost for managing and for operating a set of local branches. And of course, deregulation has caused many banks to merge. Why is IT and technology a reason for two banks to merge?
Large scale effects?
Yeah. If you have two small banks, those two small banks need to run their own IT offices and need to offer the same IT services. You could also offer by almost the same IT section, IT department within an even larger bank. So this is why many companies have merged to save on IT costs. And last but not least, deregulation, because several decades ago, the banks were not allowed to merge. And this is very interesting in the US. Does anyone know how the situation looked like in the United States, say 30, 40 years ago? Yes?
And companies like Goldman Sachs, example given, and just like private owned by the partners, or transfer to a corporation and a public company?
Yes. It also, investment banking was not allowed to offer deposit-taking services. So you had a clear distinction between commercial banks and investment banks. This was abolished by Gramm-Leach-Bliley Act, the Gramm-Leach-Bliley Act of 1999, I think. One of the last things signed into a law by the Clinton administration. Something else, 20, 30, 40 years ago. Anyone know? In fact, in the United States, up until, I think, the late 80s and the 90s, banks were not allowed to open branches in another state. So if you were a bank based in Minnesota, you were not allowed to offer a branch, to open a branch in Wisconsin and not in California. So you had laws, state laws, and I think also federal laws that prohibited banks to spread into other US states. And over a course of several decades, there was a process now referred to as the bank branch deregulation process that abolished all these laws from state to state to state, and suddenly banks were first allowed to merge with other banks and to open up branches in other states, and suddenly banks grew a lot. And of course, this was a kind of very heavy regulation and a heavy burden on most banks. And this regulation was abolished in the 70s, 80s, and I think 90s. This is also very interesting from a scientific point of view, because the bank branch deregulation is one of the most frequently used identification strategies for economic research. Why is that? In economic research, and you will learn a lot more about this in the seminar, in the Empirical Banking and Finance seminar, you're always concerned about establishing causality. If I would tell you that, for example, larger banks have a lower risk of default, and I would show you a correlation and a regression analysis, this would not mean that the causality runs from larger bank, lower default risk. It could also be that it's the other way around, that if a bank has a lower risk of default, it will increase its size, it would grow more, which is also natural. If you are close to bankruptcy, you're not investing, you will decrease your balance sheet. So it could be that X influences Y, or it could be that Y influences X, or it could be that if you want to show that X is has an influence on Y, it could be that something else influences X and Y. One famous example is, I think the English word is storch, right? For Storch. Stalks? Okay, Störche in German. The birds that bring babies. There is a correlation that in towns and areas where you have more, storks, birds, more people, more babies are born. And do you think this fairy tale is true? No, it's not. It's what we call, it's a fake correlation, Scheinkorrelation in German. It's not more birds, more babies. It's more industrialization, less birds, less babies. So if you go back 100 or 200 years in a rural society with no industrialization, people needed more babies because they needed the children to work on the fields. And they didn't destroy nature so much. So when industrialization popped up, less birds, less babies. Negative, both decrease, positive correlation. And this is important in economic research. You need to establish causality. Sie müssen im Deutschen, Sie müssen die Kausalität zeigen und beweisen. And how do you do this? In many cases in banking, if you want to study the effect of regulation, it would mean that you look at a regulatory measure and you would simply compare the situations before and after that. For example, take taxes. If I increase the taxes on banking by 20%, I could simply compare the revenues before the tax increase and after the tax increase. I could compare the default rates of banks before and after the change in taxation. But if I do this in 2010, it could show a different result as, say, in 2017 or in 1950. So if you only have one change in regulation at one point in time, it's still difficult to show causality. But with bank branch deregulation, you have several changes in regulation at different states, in different US states, over a period of almost 30 years. And this is why the Bank Branch Deregulation Acts are frequently used to show the effect of deregulation on bank risk, bank profits, bank competition, and so on and so on. And if you're interested in this, I would recommend you go to the website of I think Ross Levine. He used to be, I think, at Brown. I think he's now at Berkeley. And he's one of the authors of the very first studies in banking research who did this. Okay. Deregulation and regulation. Almost a hot topic, always a hot topic in banking research. During the financial crisis and after the financial crisis, during the last couple of years, we've only talked about capital requirements. Because usually after a banking crisis, the regulators' initial response is banks need to hold more capital. They need to have more equity. And the last couple of years have seen a vast amount of papers and economic research on the question whether bank capital requirements do an actual good or a bad job at creating jobs, at making banks safer, etc. Okay. banking services. I would say you should just look through the slides. You can see that again, deposits and credit loans, online banking has come as an additional service over the past 15 years. You will get the English slides, I think, this week, and let me concentrate on online banking. Online banking is something that has popped up over the last 15 years, I think, and is, for some reason, this is very interesting, I think between 2005 and 2010, 12, every bank had online banking. Everyone was doing it, but there were no new companies that offered services related to online banking. Only over the past 5 years, maybe, we've seen this fintech revolution where suddenly startup companies are popping up and are trying to compete with large banking corporations, especially in online banking. And what usually is done by these companies, we have money transfers, we have some commercial loans, some retail loans. You might know of companies like in German Smava, but also Prosper.com. Prosper.com is, I think, the most famous one in the US. They offer it used to be called peer-to-peer loans. Nowadays it's crowdfunding. Peer-to-peer loans is a little bit more retailish than crowdfunding. In crowdfunding, I have a business idea and I have a project I want to finance. Peer-to-peer loans is more retail based. It simply means I want to buy a new car. I want to buy a new TV for 2,000 euros. I need some cash. Okay, so these are peer-to-peer loans. You have more and more companies offering trading services. Some of them barely legal, I have to say that. I complain a lot about these sort of companies in my financial regulation course because I can show you pictures of a trading center in my small hometown with a population of 50,000 people. There are almost, the population average age is extremely old. It's an old mining city, and it now has a trading center. Actually, I have to say, it never really opened. And I think it looked exactly like a gambling hall with one distinction and one difference. The gambling halls in Germany need to cover their walls and need to cover their front sides so that children cannot look into there. This trading center did not have to do this. But you could trade in CFDs and other things, but it has already closed down, and I'm quite glad it did. You can look up a YouTube video. Maybe I should post it. You can look up a YouTube video of the opening of this trading center by some self-proclaimed investment guru, and it's hilarious. Yeah? You have a bunch of old people sitting there. I think they were just there for the drinks. And this guy is talking about your opportunities in CFD trading, yeah. Just put your life savings in this sort of investment. Yeah, probably safe. So you have a large variety of different banking services that are now offered over the internet. Trading, cash settlement, and money transfers. And one problem, of course, is that, well, some years ago still, most of this was hampered by the fact that people were very concerned about internet safety. Nowadays, it seems the safety mechanisms have improved and people care less about it. I just think that this is also one development, that people care much less about safety and security of their transfers than they did almost 10 or 15 years ago when the internet was still new. Also, one has to say that in many cases, this happened once to me. These internet companies are extremely eager to refund you in case you are defrauded and in case something goes wrong, because they are afraid of bad publicity. So this is no longer such a big problem. In many cases, especially with fintechs and these startups, how do you think these companies make their money? How do they make profits? Yeah?
Maybe small commissions or fees.
Yeah, commission fees, okay, but more importantly?
Less costs compared to like opening branches.
Less costs, but even more important than commission fees and lower costs. Data. They want to know what you as a customer do with your money. They want your address. They want your financial contact. And they want to know what you bought, with what kind of money, and which money you have transferred. And this is the data these companies will either use themselves or they will sell it off. So usually if you, for example, have a nice little finance app on your smartphone, you will probably have opted in that the company is allowed to use this sort of data, and the data you give to them. And these companies, they earn a small commission fee, but usually even these apps are for free, and these companies are eager to use the data. And in insurance, there's a new directive that is, I think, is now in effect, which reverses this process. That actually, you know it?
No,
Okay.
It's just another question.
That in fact the European Union wants to make these transaction data more available to companies. And this is, of course, a vault of information to corporations. Think of Amazon getting the information what your exact interests are and what you have bought, what products you are interested in. This is what these companies, exactly, especially Google, Amazon, and other large retail companies, this is the data they are looking for. Yeah.
But is there a credit card company doing the same, like MasterCard?
Actually, most of the banks offer the very same services like the fintechs do. And most fintechs do not intend to become the next Facebook. Most fintechs simply want to produce a nice app and then sell it to a large bank. And this is otherwise. Look at the apps of the savings and loan associations, of the German credit cooperatives. They more or less have all the same apps. And they, even if they have created their own apps, they probably have had the input of several fintechs, and they've just looked at what the fintechs have done. Yeah. And we also have, especially in online banking, we have a large B2B segment. So this is, of course, all B2C, business to customers, in the retail business. But also when it comes to business, online banking is becoming more and more important. But this, of course, is only relevant for the large commercial banks. Okay. You can also, well, build conglomeratives. We have some, for example, intralinks.com, which consists of Chase Manhattan Bank and other banks. They offer syndicated loans. This is the business-to-business part. And the FX, for some reason, the foreign exchange market has grown exponentially over the last few years, and people and business are trading heavily in foreign exchanges. And this is done online as well. You also have platforms for currencies. You might have seen those, Coronex, Cognotech, FXall. These are sometimes for customers in the B2C segment, sometimes business to business. And this is, of course, also done online because even the stock exchanges are, of course, electronic by now. The advantages of doing online business is, of course, extremely high transparency when it comes to prices, high liquidity, it's very simple, easy access, small spreads, and you can execute orders very quickly because it's all based on IT. And this will become more and more and more important over the next years. Fintechs will continue to start their own business, to generate new ideas. Banks will need to cut down on their branches, will close down branches, and will go more and more into online banking because it's cheaper and because customers do not go into branches anymore. They just go online. And this will continue for some time. Well, is online banking profitable? Well, you can think about this at home. Actually, a couple of years ago, I would say it simply is a nice gesture to customers. Go back 10 years ago, and the bank didn't care. The bank had their online banking running, and they didn't generate profits in their online banking. They simply offered their customers this additional way to transfer money. But nowadays, this is, I think, very different. Nowadays, you can generate profits, or you could simply stay alive and not go bankrupt by offering good online services. Okay. Well, you can look at this later on, and we might talk a little bit more about online banking later on, but if you do not have any questions, we'll continue with central banking next week. Okay, thank you.